My name is Don Kaufman. You are watching Vital Skills for Traders and Investors. As I was saying, there is a Q&A section. Feel free to fire questions in as we go along. Sometimes I'll pause, answer a couple of questions. Other times I'll kind of wait till there's a couple of breaks. A few things right up front. There's a risk disclosure. We are not financial advisors or a broker-dealer. Well, the reason I mention that right up front is, well, this is important because, I got my start in the industry, the last 15 years, working at a brokerage firm. A little bit about me. So again, my name is Don Kaufman. It's a slightly older picture. I have a little bit more gray hair and, a little bit less hair out there altogether. I can relate that back to having a couple of children. Anyway, I started trading in the late 90s in Chicago, and only a short time after I started trading, about 18 months after I started trading, I was invited to join what at the time was a kind of a no-name startup. Well, that startup turned into what they call thinkorswim. Well, a couple of acquisitions, a few mergers later, we became kind of the dominant force inside of TD Ameritrade. So for my career, a big portion of my career, I started in the trading side of the business. I migrated and built the education division of thinkorswim and then ran education for the 7 million clients at TD Ameritrade. I've had an 18-year trading career, and again, co-founder of TheoTrade here. That's a little bit about my background. I have 16 years of thinkorswim platform experience. However, I'm going to tell you right now, I'm getting much more familiar with other trading applications. It was about 18 months ago that I left TD Ameritrade, so I've explored other trading applications out there. With that, let's get things off and rolling. This is me versus Mr. Wonderful over there. I'm a pretty avid short seller, and this is actually now just about 1 year back. I shorted Apple and maintained a short position till Apple actually crested down to about the 90 level, but I just like to throw that up there because one of the skills we'll talk about tonight is trading. It's not about being right or wrong, but when you're up against Mr. Wonderful, just go for it. You got to be right. With that, let's jump into what we're going to discuss tonight. And I'm going to tell you, we're going to start off a little bit more basic, but we're going to get fairly extreme tonight. Is that all right with everybody? I'm going to throw some fairly involved topics at you, but I feel very, very strongly about the items that we're going to discuss tonight. In fact, I really insisted on putting this particular class together simply because there are certain skills that we find that traders and investors alike lack. And that's really what I'm going to kind of hone in on tonight. I'm going to try to hone in on really 3 major skills, okay, that are absolutely essential. And are you involved in the markets? We're going to start there. Well, clearly, most of you are involved in the markets if you're joining us here this evening, right? Then you need these skills. Easy enough to begin with. Now, the essential skills for all markets. Now, again, I don't like to make a lot of big blanket statements because one size in this business does not fit all. But the way that you approach the markets, and again, I want to be crystal clear about this. We're going to be discussing tonight whether you're an investor. Okay? I don't care if you buy and hold or if you're short the market and hold positions for years. Okay? We're going to be discussing topics tonight involving a buy and hold. We're going to be discussing topics tonight that can involve intraday trading. We're going to be discussing topics tonight that, for those of you that do iron condors or butterflies, all right, these skills that we're going to talk about, all right, we're going to uncover 3 skills you just cannot live without. And I'm going to define them initially, and we'll explore these much more detailed as time, trade logic, and strategy, okay? What does that really amount to? Well, let's get to it. Building your market skill set. So let's start this evening by defining what you are in terms of time. Now, sounds pretty ominous, right? What are you in terms of time over here? What do you consider yourself? And by the way, feel free to chat in. Again, I have tendency to watch the questions as I'm going through this. So, provide me a little bit of feedback. Like, what do you actually consider yourself? Do you consider yourself an investor? I consider that like a buy and hold, right? You hold some mutual funds, a 401k. Then there's traders. What are traders? Those are the strategists, the option traders. What do? Iron condors and butterflies, and mambo combos. And, there's all kinds of different strategies around options. Or trader would also be involved in swing trading. Swing trading is holding position for a couple of days, a few weeks there, directionally biased. Or are you an intraday trader? Intraday trader, define it. You're in, you're out. You're in, you're out. You're so in that you're out. And I think it's very important to define these right up front, right? What do you consider yourself? Because if you don't know what you are, well, there right off the bat, pretty easy skill, right? So skill number 1, define the time. This is where I call where traders become investors. Oh, what does that mean? You're about to find out. Skill number 1 is define the time. And I said, I'm going to start off a little easy on you, okay? And then we're going to kind of ramp it up from there. So we're going to start a little easy. When do traders become investors? Some of us partake in a multitude of investments and or trades, but it's critical to define what we are in each unique case. Why, you might ask? Like, why do you have to define this? Because a bad trade turned into a worse investment. Well, you ever put yourself into a short duration trade only for the trade to become an investment? I pause for a moment over there, right? Think about that for a second. You know exactly what I'm talking about. Something you bought for a short-term pop or drop, which turned into a long-term drop. Maybe? Admitting this is the first step. So pause for a moment. Go take a look at your portfolio. Most of you don't even have to look at your portfolio. And tell me you do not have a trade turned investment. Every trader does this. Okay, and then, well, no, I'm not a trader now. Now I'm an investor. What does that ultimately mean? It means you went out and you bought something, and like, oh yeah, it was a short-term swing trade. 6 years later, still own it. Now, like, almost. By the way, people are actually responding here. Been there, done that. Guilty, guilty, guilty. Somebody said not yet. Well, James, there was like one not yet. If you're saying not yet, that's because you have not traded yet. Plain and simple. Every single person does this, and I wanted to start with it because we've all done it. And by the way, I'm including myself over there. I've done this. I started in the professional side of this business, making markets and managing risk for a pretty good firm. And that's why I started. I grew up around traders too. But when I started trading in 2001, I started trading for myself. And again, I started trading in, the 90s, but when I really started trading for myself, this happened a number of times over there, Yeah, that's a good trade gone into a worse investment. So time is a skill you can't live without. And I wanted to start really easy with you. Your first definitive stride to more effective skill set is to define your time frame for each unique position you intend to take. It's like that easy. What this means is a trade for example, 1 day, okay, is closed in 1 day. Define your time. Now, I just put together just a quick and dirty synopsis of this. We're going to talk about duration investment, mid-duration trades, and intraday trading. I define them for you, okay? I group everything that I do into one of these categories. And that basically means I do duration investments. What is a duration investment? That's something long or short investments, okay, or bonds, expected time to maturity is beyond 3 months. All right? Mid-duration trades, swing trades. If you're not familiar with the swing trades, all right, it's lingo. You get long, you get short. You hold it for a couple of days, multi-leg option strategies, etc. That includes the butterflies and the iron condors and broken wing butterflies. You name an option strategy, I've been there, done that. Expected time to maturity is days to 3 months max. So why do you think it's important to define your time? Intraday trading, active intraday trades entered and exited in the same trading session. sometimes it's easy to look at something, like on a slideshow and go, all right, I get what he's saying, define my time over there. How critical is this? If you're going to do an intraday trade and you leave it on overnight, you're toast. That's going to turn into a mid-duration trade, which is going to turn into a much longer, crappy investment out there. By the way, yes, that's a technical term in trading. All right? Basic skills pay big dividends. It sounds easy enough, right? You must define your time frame for every position you encounter. With something this easy, why does this cost traders and investors alike? It's tens of thousands. Okay, almost every single person in here, right? I wanted to hit a little bit of a sore spot to start with. Almost every person in here is not really good at defining your time. Would this first skill have saved you some money? Of course it does, all right? Time and duration is a known weakness of traders and investors. Define your time. And again, if you want, we'll hand you this PowerPoint presentation. It's this easy. Duration, mid-duration, intraday trading. Right? Great. I started this evening with a really straightforward skill. Most of you, well, you could have figured that one out on your own. Realize for the last 15 years, okay, I have worked educating and watching order flow for thinkorswim and TD Ameritrade 7 million clients. So the bottom line is I've looked at, literally hundreds of thousands of accounts. We used to run studies on accounts. We figure out what works, what doesn't. What doesn't, it just gets repeated over and over again. And a lot of the skills that I'm talking about tonight are some of that gets repeated over and over again. Like you're coming here and you're spending your time tonight, to watch this. I want to make this really, really evident. I want you to be able to leave with a few skills tonight that you can employ immediately. And I think one of the easiest things to do is to just talk about, first define your time. That's easy enough, right? That's something that's going to resonate with you, something you're going to remember, okay, as time goes on. Now, we're going to step it up a few notches. Everybody ready? All right. And again, everybody learns this the hard way. I like that comment because it's true. You really don't want to learn by the school of hard knocks because that's why I put this particular slide in here. Okay. I cannot stress enough, one of the things I'm really good at is defining some of the weaknesses in retail clientele and professional clientele, because in the end, I have to tell you guys, the buck stops here. And by here, I mean with me. I have seen everything. Okay, I ran the entire education division for TD Ameritrade for 5 years. There's nothing I haven't seen. People emailed me every single day. Help me, Don. I've seen counts upside down by $5 million in 5 minutes. And I don't say that to scare you because it's something as easy as a little flaw in the logic out there. So as I'm saying, now we're going to step it up a few notches, and this is where you better get ready for it. Skill number 2, trade logic, the test of occurrences. And I feel really, really strongly about this because most people have just no clue. Skill number 2, trade logic. The second skill for this evening is trade logic. What does that even mean? People are like, is that logical? What is trade logic? If you're an investor or a trader, you need to employ the right logic. Okay? And somebody actually is chatting in over here. They're like, statistical probability. That's where I'm headed. That is exactly where I'm headed. Risk, for instance, versus reward exposed. Now, I don't want to get into statistics and probability too hard because we have an hour to spend together here, and I don't want to, blow everybody completely out of the water, but I am much more of a quantitative trader. I'm not sure anybody's ever heard that terminology before, the word quote unquote quant. I grew up around quants, okay? And this is the kind of area as a quant that we learn to exploit in the marketplace. So let's provide an example of what trade logic can do for you over the duration. This is trade logic over time. And again, the easiest example that I can come up with is let's take a very simple and frequently used idea of risk $1 to make 2. Everybody heard that one? Has everybody heard that one? Anybody? Yeah? All right. So, all right, excellent. Lots of people chatting in over here. Part of the understanding in trade logic is recognizing that whatever you're going to do, in the markets, it must stand the test of 1,000 occurrences. Now think about what that is. It's the test of time and 1,000 occurrences. So don't look at, somebody will jump over to a chart. And I'm going to jump around a little bit tonight. I hope you guys don't mind. This happens to be the thinkorswim platform. It doesn't matter. It's a chart. Okay? And they jump onto a chart and they're like, well, look at the MACD and the Fibonacci and the Bollinger Band, and this thing is going to work for me. But they forget about one very simple piece of logic over there. It doesn't matter what you think. What you think only goes so far, because nobody else cares what you think, right? You shouldn't even care in terms of I think we're going up or I'm thinking we're going down. Whatever you're going to do has to stand the test of time and 1,000 occurrences. Meaning if I did this again and again and again and again and again, would it make money? Okay? Good logic gone bad. You ever questioned what your probability of being stopped out of a trade might be? Probability of being stopped out of a trade can be calculated using what we call probability of touching. Now, I'm going to take it easy on you here, but I'm going to advise you right now, you may not look at trading quite the same after this example. Okay? Like somebody, I'm overwhelmed by indicators. You should be. All right? There's 419 indicators just on the thinkorswim platform. Should be overwhelmed. Probability of touching. Okay? Now, here is something that if you've never traded options before, that is okay. This does relate to options, but it is not, critical for you to understand and trade options to understand probability of touching. Probability of touching. It's the probability of an individual option strike price being touched or surpassed any time between now and expiration. It has no directional bias. Calculations to solve for probability of touching are implemented from options implied volatility. You're like, what? Here's probability of touching. You ready? I'm going to sketch this out for you really, really quick. So when you look at an underlying stock, this is a good way to look at an underlying stock. Doesn't matter what stock it is, right? This could have been, Netflix, which traded today from 100 to 120. It could be any stock, all right? In fact, it's not just any stock. It's a stock called stock, right? So that's the name of the stock. It's stock. And let's say stock is trading at 100. I don't know. What's the probability of this thing going up, for instance, to 105 versus, for instance, down to about 95? Now, if you step back from that, we're not going to use any MACDs, any Fibonacci's, any Bollinger Bands. Step back from it and look at it, all right, from a mathematical perspective. And it's, there's an equal chance of it going up to 105, the same as it going down to 95. Assuming you know nothing about direction. Well, so there's can move up $5, can move down $5. Well, depending upon options, options put a price tag on risk to the future. So if you look at an option, and an option is 30 days out, that puts a price tag on risk in 30 days. Do you know what an option really does? An option is calculated as a probability. It might say something like, well, based on current risk in the marketplace, because volatility is risk, all right? That's what implied volatility is, just risk. Probability is just related to implied volatility, which is risk. So you could say based on current risk, there's about a 70% probability we can go to 105. Conversely, there's a 70% probability we can go down to 95, right? And I'm going to actually show you this in real context here momentarily. Now, bear with me for a second. When you actually move forward, probability of touching and stop orders. Let's see, how this would influence you in a real example. So here's a live example. And again, I want to walk you through this and how it works. And then I'm going to take you into the live market. I'm going to show you a live example. Assume that you purchased a stock right at $60. Okay, so there's a stock right at $60. You set your stop order ultimately at 59. That is the stop. Then we have what we call a target, right? The target price of 62. What is the probability in the next 29 days of being stopped out versus hitting your target price? Now again, this is absolutely critical because when people talk about directional bias, well, there's a directional bias in the marketplace over there. Okay, in the short duration of 30 days, you have to assume, forget about direction. Even if you could pick direction, it's not going to matter because you're going to get what we call normal volatility fluctuations. Even if we're going to trade to the upside, we're still going to have normal volatility fluctuations. And the further you go out in time, the larger the fluctuations become, because the more time you have, the more the stock can do what? Move. So let's look at this in real context. This happens to be Starbucks. Now, I took this screenshot a while ago, but I'm going to take you into a live example here momentarily. This happens to be Starbucks, and Starbucks was trading right smack at $60 on the button. I used a 29-day expiration, and I wanted to show you this. Anytime in the next 29 days. What's the probability of going to 59? The probability of what we term touching. There it is. There's a 79% chance we touch the 59 level in the next 29 days. On the flip side, there's only a 56% probability, okay, of touching the target price of 62. Now, stop right there for a second. How are you going to fare? Now, if you're looking at this for the very first time and you've never really seen probability of touching, all right, whatever. So what are you saying here, Don? You have an 80% chance of being stopped out. On the flip side, you only have a 56% chance of hitting your target price. I don't care if you know which way the market's going to go. It doesn't matter. That's the thing that people don't realize about this business. Okay? What you think, put it to the back burner for a moment. It's not about what you think. Look at the mathematical occurrences in this particular trade. The entire logic here is flawed. That's why I put stop is a 4-letter word over there. Again, I'm going to go into a live example here momentarily, but just trading is about a number of occurrences. Pause for a moment and recognize the significance of the last example. If you do 100 trades with the aforementioned logic, you are positioned to be stopped out 79% of the time. So what does that mean? Well, if you're stopped out 79% of the time, how profitable are you going to be? Because people are always going to tell me, I can be right more than I am wrong. Yeah, that's fine. But it doesn't matter because you're still going to be wrong about 79% of the time because, again, it's about the number of occurrences. When you approach trades and investments, it's vital to look at the flaws within the logic itself. Now, let me take you back to a live example. And I found one earlier in a stock that's been a little bit volatile lately. Okay? So bear with me for a second. It's Wells Fargo. It's been through its earnings. Okay? Now, you define the time frame. You want to define it for November 4th? That's 17 days out. What I'm getting at here is you could be a short-term, like swing trader. You could be a longer duration options trader. You could even be a duration trader. You could be an intraday trader. This is a skill that transcends time. So let me walk you through this idea. Here we have a stock. It's trading pretty much at 45 on the button, right? It doesn't get much closer to 45. Look, example, if we put a stop order, this is probability of touching here. And if we put a stop order right at $44, right at $44. So what's the downside risk? You're like, it's only $1 of risk. Sweet. What's your upside potential? Well, if you put the stop at 44, then you wanted your target price to be $2 higher. So that's going to be what? Well, it's $45 plus about $2. Let's move it up to what? 47. Take a look. How's that grab you? Okay. Stop for a second. Breathe. There's a 68% chance of touching 44. On the flip side, there's only a 21% probability of touching your target price of 47. Okay. Now, this is one of the most critical things because, immediately somebody will say, the probabilities, they're right here, right now. Really. But the volatility has been around 20%. The probabilities will continually, all right, crush you if you don't overcome a very simple strategy flaw. And it's one of the most important things that I can really implement to you immediately. Now, that's for 17 days, but maybe you didn't do it for 17 days. Maybe you did this, for the next 38 days. Look at it for 38 days. Maybe you wanted to risk a little bit more out there. Okay? Setting stop orders, again, at 44, you have a 77% probability. Probability of getting to 47, only a 38% chance. That's probability of touching. Okay? Now, even if the market moves and the probabilities are shifting out there, do you think the mathematics change? Absolutely not. And that's why I wanted to throw a live example in here and just recognize in any way, shape, or form, even if you do this for intraday trading, if you set your stop considerably closer, okay, the probability of being stopped out is almost double the probability of hitting your target price, which means you're not going to have to be right 50 or 55% of the time. You're going to have to be right like 80% of the time just to be able to break even. And it's one of the first things that they teach you at a trading firm is that simple logic out there. And I cannot stress this one enough. When you approach trades, again, in investments, it's vital to look at flaws within the logic itself, okay? Think about this. Have you ever been right and still lost money? Of course you have. Many traders have suffered the wrath of the stop order. I'm not saying don't ever use a stop. There are some effective means to using stops. Like, I don't want to bash stop orders too badly. But how you use this logic, okay, it can't be in that risk one to be able to make two scenario, right? You got stopped out only moments later to see this, see this stock, that's supposed to say stock, turn around the way you intended. I mean, that's what really happened. So literally you get stopped out, and then the stock runs up. Or here's another big flaw. Maybe you bought a call option expecting the stock to go up. The stock did go up and you still lost money. It just comes down to a very simple idea. The trade logic and approach to every investment, it's the single most essential skill we can really impart upon you. Are your trades logical? Right? Logic it's always going to be my forte because, again, I grew up around traders. When I say I literally grew up around traders, I grew up around traders. And the one thing that I learned very, very early on, literally as a kid, we used to play, games, but they were games of logic and so forth. Because, again, I had traders in my family. It wasn't a game about hey, which way you think that stock is going to go. It was games always about logic. And, again, it's a really significant portion of what we do here at TheoTrade. If a trade idea or concept does not stand the test of 1,000 occurrences, then what, may I ask, is the point of doing the trade in the first place? Okay? And this trade logic and skill ties directly to the final skill for this evening. And the final skill for this evening, again, we're going to kind of step it up as we go a little deeper into this. So it's good stuff. Skill number 3, strategy. Who needs direction when you have strategy? Now this is a big one, and I always let this sink in. Who needs direction when you have strategy? The one thing I'll also impart upon you is direction of the market important? I can say this unequivocally, yes. Direction of the market is absolutely important. Now, what is the direction of the market? When I say direction of the market, well, you can get bullish, right? I think the stock's going up. Or I can get bearish. I think the stock's going down. Or you can actually get what we term neutral. I think we're staying flat. But neutral is a direction unto itself. Now, the one thing I want to impart upon you, this is not everything. And you're actually going to put direction, okay, and your directional bias behind your strategy and your trade logic. If you don't, this is where people fail by far and large the most in this business. And let me impart this idea upon you before I actually get into strategy itself. I'm going to impart this upon you, and it's going to make you think about the markets a little bit differently, okay? I worked for an extremely successful firm in the 90s, and that firm, okay, there was something that resonated with me and resonates with every single trading firm on this planet today. Every single trading firm. Do you think that they base billions of dollars every day based on what some monkey thinks. And when I say some monkey, some trader, okay? Anytime you hear about an individual trader working at a big firm, think about this. Anytime you ever hear about a big trader working at some big firm, it's because they took some ridiculous directional position and lost money doing it. Everything that these firms do, yes, direction is part of it, but it's all about their strategy. It's about their trade logic. It's about their allocation out there. They put, okay, directional bias, not necessarily to the back burner, but it's down the line. You don't risk billions of dollars based on what you think. Okay, and I wanted to impart that upon you because when you think of these trading firms, sure, people get on CNBC all the time. I'm bullish, I'm bearish. I'm so bullish that I'm bearish. But they don't talk at all about the strategy that they employ to be able to sustain positions for periods of time. I mean, sure, they're bullish or bearish. That's great. What strategy are they employing? Right? It's one of the most important things. And that's why, who needs direction when you have strategy? Let's get into it. Skill number 3, strategy. Finally, the strategy you employ in the markets, it's vital. So strategy really incorporates a multitude of our skills. It incorporates time frame, trade logic, and capital allocation. They all kind of get lumped into strategy. So turn the tables with the right trade logic and really the right strategy. In our previous example involving trade logic, we got stopped out of trades early and frequently. Probability was working against us as we had a much higher chance of being stopped out of the trade, okay, prior to our position making money. And that's what we're going to try to turn the tables. And again, a very simple idea in this particular case. Very, very simple idea to turn the tables over there. We don't need no stinking stops. Now, I told you I wasn't going to bash stop orders, but I say no to stop. Okay, I don't mind telling you guys this, and don't hold it against me. I do not use stop orders. Okay, I have never used stop orders other than to test thinkorswim and the thinkorswim software. And you'll also find this kind of amusing, but early on in the thinkorswim days, we actually fought. Okay, this is people that ran the firm. We fought hard and long about ever adding stop orders to the trading application, because every one of us, okay, that worked at thinkorswim had made markets at some point. And we all thought it was like a joke when retail clients use stop orders. We're like, they're a sitting duck. They always put stop orders in at big round numbers and so forth. And again, I'm not totally anti the stop order in today's marketplace. I can help you strategize around it. But here, we're actually going to build a trade where you don't need a stop order. We're going to define your risk without the use of a stop order. Basically, it's going to allow you to hold the trade even though, okay, you can fly through the most adverse conditions. Just, you got to fly through the most adverse conditions. I call it flying through the adverse conditions because on a day-to-day basis, you can't stop wild swings in the market. You can't. Even if you're trading on an intraday basis, it doesn't matter. You're going to get stopped out. You're going to get ripped apart. News comes out. Janet Yellen is waiting for you. Okay. Stanley Fischer is off in the wings over there, just waiting to pounce on you. These are all Fed speakers over there. Throw a little bit of WikiLeaks in there. And the next thing you know, you're going to get stopped out. We're going to use in-out spreads. Now, I've discussed in previous sessions that I've done in-out spreads. So in-out spreads are option spreads designed to limit your risks while allowing you enough time, okay, in a trade. What that basically means, so we're going to go out there, we're going to put on an in-out spread. Now, you don't have to know a huge amount about options, but allow me to present the strategy and logic of the in-out spread because, again, this is about 3 primary skills. We had time, then we talked about trade logic, now we're talking about strategy. And I wanted to give you a good example of what, okay, strong strategy can do for your trading. So again, even if you don't understand options, it's all right. I just want you to understand the bottom line, the logic of the strategy and why it's so viable. Do not let options intimidate your learning about how to effectively manage your risks. All right, let's get into it. setting up an in-out spread. And we're going to, I can do this. In fact, I can even put on a couple of live examples over here if you guys don't mind. Yeah, maybe. Anybody? Some live examples. So here I took a screenshot of Starbucks. Right? I use Starbucks over there. I use Starbucks for a lot of examples. Apparently I'm a well-caffeinated individual, but here's Starbucks. And Starbucks was trading at 52.74. I'll look at it here in a moment. So what I wanted to do is we're going to buy, in this case, the 52 calls, and we're going to sell the 54 calls. That's it. Why do they call it an in-out spread? It's one strike in the money, one strike out of the money. Now, for those of you that have absolutely zero options experience, that is A-okay with me. A 52 call. Okay, let me explain this in a bit more detail. So here we are with the stock trading at 52.74. We're looking at options that are about 39 days prior to expiration. That means you have 39 days to live. That's it. 39 days to live. Now, let me ask you, what can happen to this stock in 39 days? Well, I selected Starbucks knowing that it even had earnings coming out. It does. It has earnings coming out soon. So the answer is it could do a lot in the next 39 days. So recognize if you used a stop order or something, it's a pretty good probability you're going to get stopped out because you're going to be wrong at some point in the next 39 days. But to find the time, we'll use 39 days. We're going to buy what's called a 52 call. Now, if you don't know your options, what's a 52 call? It's the right to buy the stock at what? 52! So I have the right to buy the stock at 52, but then I am simultaneously selling the 54 calls. And when you sell a call to somebody, right, I have the right to buy the stock at 52, but I'm selling a 54 call. What's the 54 call doing? It's giving somebody else the right to take stock from me at 54. You say, but I don't even own any stock. That's okay. You don't have to own stock. Because if somebody wants the right to take the stock at 54, you have the right to take stock from somebody else at 52. If you take the stock at 52 and have to give it to somebody else at 54, how much do you make? $2. It's a $2 wide spread. Now, this is done simultaneously. Again, buy one, sell another. It's called a vertical spread. The reason they call it in-out, because it's one strike in the money, one strike out of the money, one strike in the money, one strike out of the money. In this case, it's done for a $1 debit. $1 debit. What does that mean? It means $1. How much does it cost? $1. What's the most I can lose? $1. What's the max risk? $1. If the stock goes to zero, what can you lose? $1. Can I get stopped out? No. But you only have 39 days. 39 days to do what? For the stock to get a bit above 54. Now, by expiration, you need the stock above 54. If the stock is not above 54, by expiration, okay, you might lose some money. But the fun thing is your break-even point in this stock is actually 53. So roughly speaking, the stock is pretty much at 53. So if the stock stays flat, you break even. If the stock goes down, you lose $1. If the stock goes up, you'll make $1. You're like, but I'm risking $1 to be able to make $1. I don't like that. Yes, you are. You're risking $1 to be able to make $1. But what's going to happen in the next 39 days? Stock's going to go up, stock's going to go down, stock's going to go up, stock's going to go down. I'm not going to get stopped out and lose the $1 because I know I have $1 of risk. When the stock goes up, I exit the strategy profitably. If the stock goes down, I hold the strategy. Okay? The whole design of the in-out spread is to be able to weather the storm. It's a very smart little piece of logic over here because what it does is when you employ the strategy, it makes you impervious to the risk. At the very least, let's say this. Here's another way of looking at it. Let's say that you are the worst stock picker in the universe. You're the worst stock picker in the universe. Dun, 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 dun. And every time that you want to pick direction, you just flip a coin. Heads, you're bullish. Tails, you're bearish. If you're bullish, you do a call spread. If you're bearish, you do a put spread. And that's how you're going to select direction, let's say, from now until the end of time. Theoretically, you should be right about half the time, yes? Some people will say, well, the market over the long run goes up. Yeah, but that's actually not true. The S&P 500 goes up, but they manipulate the S&P 500 by adding stocks that perform to the S&P 500. But if you looked at individual stock performance, you can't say that it goes up over time. It's a long, detailed story. So let's say you flipped a coin. Do you realize if you were the worst stock picker in the world, but you had good risk management, you could still theoretically be profitable? Why? Even if you're wrong on direction, the stock oscillates up and you might be able to exit this thing profitably. Or even if the stock oscillated down, you don't exit and then it oscillated up. You're not going to get stopped out. It's a great piece of logic to use. That's why we show things like in-out spreads. Now, let's go to a live market. Could I do one in Wells Fargo? Yeah. What would you want to be? You guys want to be bullish? You want to be bearish? Anybody? Do you want to be bullish? You want to be bearish? Stock's trading right at about 45 bucks. Bullish, bearish, bullish, bearish. Come on, they got a new CEO. Wow, every one of you that has typed in so far, and there's a lot of you, have said bearish. I kind of like your attitude. All right, so here's a bearish one. Okay. Now this bearish one, now this is interesting. This is actually trading for just over $1. It's live. Like I can't, you can't make up the prices over here. It's trading for just over $1, but it's a 46.44 spread. You want to see something cool too? That's for the November 18th. Why did I do it for November 18th? Could I have done this one 38 days out? I could. I could do this thing 38 days out. You know what the irony is? If I do it for more time, did you see that? For 38 days, it actually costs me a penny less. Now, don't let this strategy, okay, like persuade you. This looks a little confusing. It's easy once you know what to click on. Now, here's another one. I've actually been trading a lot like energy sector. I've actually got, you can see, I've got a bunch of positions on the energy sector. In fact, here's a spread. It's an in-out spread on the energy sector. It's almost ready to come off over here. And if you were to do one of these in the energy sector, and I just liked in the energy sector, and the reason I like to go to the ETF products, okay, or maybe not even the energy sector, maybe I just go to the spiders. Why? Because everybody knows the spiders, right? Maybe I just go to the spiders itself. If I wanted to get bearish in the entire market, and I really wanted to define my risk, okay, I could go like do a 215, 213. Look at this. It's a $2 wide spread. The max risk is 78 cents. That's over the next 38 days. But could I do the trade for less time? Sure. But even if you do less time, like let's say I do, this is November 16th now. It's still going to cost me the same amount. See, the in-out spread, not only does it define your risk, but it offsets time. It's one of the most important things about the spread. It offsets time. Okay? And again, very important over here. Now, if you own a stock out there, sure, you can own it. You can offset a degree of your risk by using their spreads. There's so many different facets of using these spreads. Again, I don't want to tell you right now, okay, what I think about markets. Well, we're going to go up or we're going to go down. I'm going to tell you right now, I'm a long-term bear. I love being bearish over the duration. But remember, I started the conversation today talking about duration. Then we're like mid-duration. This is a mid-duration strategy. Okay, and it's a logical strategy in that mid-duration. And that's why, like one of the things, when it comes to like setting up strategy, you got to think about these in-out spreads. Now, recent in-out spread examples. So I'm going to go into my trading account and display a few recent in-out spreads. Okay, and I looked through this and I thought about it. Oh, the spiders. By the way, in the last 200 days, I've kind of done a lot of trades in the spiders. Nothing big. This is all stuff that I've done, on an intraday, some of it duration stuff, okay? The spiders it's kind of convoluted out there, but let's go look at some in-out spreads I've done, for instance, on Amazon, okay? Well, here we go. This is the last 200 days. These are all live trades, just so we're clear. It's a live account, okay? Obviously, I'm a pattern day trader. I trade pretty frequently. If you've never seen thinkorswim, that's fine, okay? I'll start with this. This is Amazon. This is all my trade history in Amazon over the last 200 days. It's not something I'm wildly active in. And you look at these, I trade small. It's because I'm doing it in front of the clientele of TheoTrade. But here's where what? Apparently I shorted, if you look at the date and time, I shorted some stock, bought that stock back. That was an intraday trade. Here is an in-out spread. It was actually placed in July 8th. And you can see I actually did 1, 2, 3 of them. I did 3 separate of the exact same trade. Looks like I paid $1.21 for it. I exited the trade. All right, it was a July 8th expiration. You can see I actually put that on June 6th. I exited the trade. All right. Apparently I paid $1.21 for it. Didn't kill it on this spread. I made what? $1.91. So what did I make off of it? Pretty much 70 cents. Okay. You can see the entry and the exit. Here's another entry. I bought 1, 2, 3 of these little monkeys. Okay. I paid about $2.38. This was entered into what? September 28th. I exited it. When? That was yesterday. Exited it for $3.40. Not exactly, again, killing it, but quite consistent. And if you know Amazon, all right, if you know Amazon, this is what I stood in the face of. That's what I stood in the face of. I did a bearish spread. Bearish. In fact, go back there and look at them. These were both bearish trades. Bearish trades from June to October. Both of them were bearish trades. This stock did nothing but go up, and both of those trades were profitable. I'm telling you, it's not just about direction. The directional bias, it's important. I needed the stock to back off a little bit. But don't you think the strategy had a lot to do with it? That's why I implement that. The next one I'll throw up here, one of my favorites, okay, is Bank of America. Bank of America, the last 200 days. All right, so in Bank of America, here's a spread I put back on all the way in April. So there's an April spread for 50 cents. I closed it for a 78-cent credit, right? It's a 10 lot. It was actually only a few days later. Put it on, took it off May 4th, right? Not a half bad return. I went out, did it again. This was for a Sep 30th. This was actually what? On August 29th. And you can see I placed a couple of them on August 29th. Then I did even more of them of a different expiration cycle. So you can see at this point, I've got, a bunch of these and a bunch of these. Basically, I've got like 20, 30 contracts stacked in here. Put them all on for a 50 cent, right around a 47 or 50 cent debit. Every one of them was exited, and you can see, all right, all 20 contracts were exited at that point for about 72, 73 cents. The reason I bring up Bank of America, I'm bringing up stocks intentionally that have actually gone up over the duration, yet these were actually put spreads. This was not a bullish trade. These were bearish trades. Okay, that's the point. By the way, I do plenty of bullish trades, but I wanted to show you bearish positions that still worked. Now, last but not least, here's another fun one. I did one on Pepsi, and I liked the Pepsi trade because, again, it was kind of off the beaten path over there. Like, nobody ever trades Pepsi, but here I actually went out and bought a spread July 14th for 84 cents, knocked out of it for about $1.30 credit just about 2 weeks later. And again, if you look at Pepsi, what did it do? The exact same thing as everything else. Trended to the upside, yet Don is just crazy enough to once again have a put spread bearish. In the face of adversity, it's all about holding trades in the face of adversity. And I cannot stress that enough. At the same time, here's what you really need to know. What stocks do you trade this on? How do I determine if I'm going to be bullish or bearish? So everybody wants to know that. Now we have scans for that. What expiration do I select? If I go back there, you can kind of reverse engineer my trades a little bit, but the expiration you select is critical. You got to give yourself enough time, but if you give yourself too much time, okay, the trade's not going to mature. What strikes do I use? It's one strike in the money, one strike out of the money. But on something like the spiders, why did I do a $2 widespread? And why not a $5 widespread? Position sizing. How big do you go? Did you notice I actually traded, relatively speaking, small, okay? And at any given time, I don't mind telling you guys this, I trade in my account with I keep on average about $300,000 in the account. You can trade these strategies, you have to have over $2,000 in the account, okay? And that's not my rule. That's not TD Ameritrade's rule. That's not Charles Schwab's rule. That's actually a FINRA rule for using spreads, right? What's the correct probability for each trade? How do I execute the trade? Like going out and physically executing it. When do I exit? What do I do in a losing position? All of this is what we call criteria. It's what we do at TheoTrade. Like we build recipes. Trading, it's all about answering the what ifs. Okay? People spend tens of thousands of dollars to educate themselves in the markets, but most education, it lacks that basic foundation and understanding of the markets. How would you like to know the essential skills all traders and investors alike need for consistency and success? That's the theme tonight. That's what we do. That's where, we provide those answers to any of the trade-related questions. We build, again, recipes with definitive entry and exit criteria, checklists. The way that I kind of think of trading, it's just like a pre-flight checklist. Everything we do, step one, what do I first look at? Well, how do I select an underlying? Is this liquid enough? Okay. What expiration? How much do I pay for it? All right. And again, don't let any of the options intimidate you away from learning how to effectively manage your risks. You got to look at them for what they are. And I always say, like, the secret's in the sauce. Now, everybody looks at this, and the one point I want to make is, you can read about spreads anywhere. Go right now and you Google what an iron condor is. If you Google an iron condor, 5,000 results are going to come up, all right? But the following strategy and corresponding criteria, it's all about the detail. And we spend months fine-tuning these trades, setup, and criteria. It's all about following the steps to be able to build a trade, all right? And that's what we get into. I mean, you want the steps for the in-out spread out there, and that's what we kind of answer. And here's some general questions. Can I trade this stuff in my IRA? Of course you can. You can do this in an IRA, tax-deferred accounts. As long as your brokerage firm understands options, you can trade this in an IRA. If you have limited capital, can you do these spreads? Yes. Got to have at least $2,000 in the account, okay? But taxable, non-taxable. What if the stock sells off big? We'll tell you definitively what to do. What if the stock rallies massively? Of course. That's what we're here to answer questions for. Do I have to monitor these trades every day? I get that question all the time. You can use what's called a GTC, good till canceled. You can set the strategy and completely forget about it, right? Everybody that follows our trades at TheoTrade, what they do is they put the strategy on. We send you an email, put it on, and they set a good till canceled. What's the correct return for the strategy? So this is all part of essential skills for consistency in trading. So in the last 45 minutes, just exposed you to a little bit of the value and how essential a foundation and skill set can be. In a few hours of time, obviously, we could do a lot more. And what I talk about is, again, it's about 18 years in the business and 15 years of watching order flow on thinkorswim and TD Ameritrade. I put together a course detailing the single most essential skill set traders and investors need for duration success in the markets. And the class that's coming up over here, it's the essential skills for consistency in trading. It's a class coming up October 29th. Now, we do things like in and out spreads, okay? But this class on October 29th, it's a 3-hour class. It's going to focus exclusively on essential skills, okay? That's going to transcend everything from intraday trading, mid-duration trading. You'll actually see on the screen over here, I mentioned this mid-duration trading, and duration, which is long-term investments. I am actually teaching the class on Saturday, October 29th. The class is $197. However, tonight I detailed part of a strategy of what's called in-out spreads. The in-out spreads course is going to be included as a bonus in addition to this 3-hour essential skills for consistency in trading. What I'm telling you is, if you like the idea, we just skim the surface of a couple of skills that we're going to exploit and explore really deeply in this 3-hour class. And again, of all the classes that I've done thus far this year, this, again, it's a skill set that just transcends, okay, time. And it transcends, again, whether it's a mid-duration, intraday trade, the class itself, and I'll go over some of the curriculum of the class, but the class is also going to include 4 other classes. And we're doing that, again, to package them together because I want to make everybody well-rounded. Like, I can't stand the idea of, like, come to this class, then we'll sell you another class and sell you another class. Listen, there's 5 classes included in here for $197, right? The first class, if you're an absolute beginner in options 101, the basics and beyond, it takes somebody that has never traded an option before, and I cannot stress to you enough, this class comes up October 29th. There's some expectation in this October 29th class that you understand a bit about options, okay? So I'm telling you, right here, right now, make sure you understand Options 101. Frankly, even if you understand options, please do me the favor, go to the Options 101. It is a 5-part series. It's worth the time. Then Options 201, Vertical and Calendar Essentials. It's essential that you go to 201, 101. Each of these are 5-part sessions. I know there's a bit of a time commitment. If you want to learn this stuff, you got to like this stuff. You really do. If you want to learn this stuff, you got to like this stuff. Options 101, Options 201. Then go to the High Probability In-Out Spreads course. It's a mid-duration strategy. It has all the criteria that I talked about. And again, in the In-Out Spreads class, it literally, okay, has step-by-step criteria. There's a checklist associated with the class. And at the end of the entire class, it actually gives you a Cliff Note version of that checklist. More importantly, it's what we term a mid-duration strategy. It's for those of you that want to get in positions, get out of positions, get in positions, out of positions. You do not have to monitor these heavily. That's why I actually selected the In-Out Spreads course for discussion tonight. In addition, again, to the Saturday class, another bonus over here is getting short and collecting income. I like to be, right now, long duration bearish on the marketplace. I really do. I want to be long duration bearish, but I'm going to show you how to get short and why getting short right now and collecting income can really pay off. It's because there's skew in the options chain, and that's a duration strategy. Both of these bonus classes tie perfectly into the primary class that we're going to be doing on October 29th. And again, on October 29th, it's about the overall skills. It's about getting the right logical trades. It's the entire approach to the markets that we're going to be covering. And these skills are going to be implemented in everything that you do over there. By the way, if you want to sign up for it, it's TheoTrade.com/skill. Now, the class that we're going to do on Saturday, again, TheoTrade.com/skill, and I'll go over it in a minute. It's essential skills, okay, for consistency in trading. I apologize there. Apparently I zoomed in. Here's some of the curriculum. How to use the right trade logic to approach your trading or investing so you know if the strategies you utilize can stand the test of time. It's the number of occurrences. It's one of the things I'm going to cover. Entry and exit criteria is the key to consistent returns. You're never going to be left guessing what options to trade. This is one of my favorite ones. How to identify and correct flaws in your trading. So we're going to actually make you consistent enough to go into your own ideas and strategies and test them. The principles of building trades so you can apply it to future investments out there. Allocation techniques. There's actually a big section in the coming class over here for allocation techniques. You know, you'd be surprised how important allocation really is. Allocation, in many cases, is the defining factor of whether you can hold a position or either you're going to get crushed. And everybody knows what I'm talking about. Meaning like you couldn't hold it because I was over allocated. We're actually going to figure out what your threshold for pain is. How to understand market risk. It's expected move, all right? How to take direction out of the equation so you can, really create trades on market volatility and not just direction out there. And again, market expectations, again, expected move, how you can use also option pricing, even if you're not an options geek out there, to generate success as a day trader, swing trader, or long-term investor. So we're actually going to show you how option pricing denotes risk in the marketplace over there. And again, all of that's coming October 29th. These bonus classes, however, you sign up for it tonight. Start watching it. I cannot stress this enough. There's 2 weeks, all right? Less than 2 weeks. It's 10 days pretty much before this class. You got to try to get some of these classes in. And I know it's going to be tight on time, but you're going to, listen, everything is recorded out there, right? But I still urgently want you to go and check out In-Out Spreads because it's going to give you a much better feel for what we're going to be talking about at Essential Skills for Consistency Trading Curriculum. And again, there's 5 courses included in this. So, or would you like access to every class we've ever done? And access to every class we're going to do for the next year. So you have an option here. You can go to those 5 classes, or you can have access to every single class we've ever done and every class we're going to do for the next year. TheoTrade.com/skill. All of the bonuses with the class and will include what? Options 301, Volatility Essentials, Guide to Selling High Probability Spreads, This is selling spreads, surviving the extreme volatility, an iron condor class, selling premium and managing risk, a covered calls class, a weekly options class, a fractal energy. This is a directional bias class taught by Doc Severson. Increasing vertical spread probabilities with technical analysis. Again, another Doc Severson class. Small account options trading workshop. The top 10 skills for growing a small account, plus a minimum of a class a month. We charge, it's $9.97 for an entire year. But the one thing I want to point out, you get the 5 classes, you get all of these classes, plus you get an additional, at minimum, a class a month. It's $9.97 for the entire year over there. So let me actually bring up the site and show you a couple of details about this. And again, you select, it's $197 or $9.97. And again, I want to put the web address up there. And feel free, like, all of our information is on this site. Okay, and again, I've got the support at TheoTrade.com, got our phone number, but that's all listed right here as well on the site. You can even chat into us. All right, so there's chat. We are here. Apparently we are here over there, so you can chat in as well. But I want you to see some of the details over here. Again, I've gone through a lot of the essential skills for consistency in trading, right? Again, the right trade approach. That $197, again, it includes bonus 1, bonus 2, bonus 3, bonus 4, and bonus 3 and 4 are, again, they're pretty critical. The high probability in-out spreads and the guide to getting short and collecting income. By the way, with the guide to getting short, it doesn't mean that you have to carry the stock position. Even if you have a small account, it'll show you how to do this with options and options alone. Now, one of the questions that's coming up in here, okay? By the way, do you have a course on technical analysis basics included in there? So Clive had a question. So I am a little bit more of a quantitative trader. I'm an options geek. But one thing I did not mention to you guys, and I should right now, we have Doc Severson, all right? A lot of people have heard of Doc Severson. Doc Severson's one of the instructors here. I want to make this clear. TheoTrade, it's not just about, Don Kaufman. It's not about me. We have Doc Severson. We have Jeff Bierman. Jeff actually worked with me, okay, for 7 years at thinkorswim and TD Ameritrade. We have Tony Rago. He's a futures trader. If you ever wanted to learn to trade futures, Tony Rago. We have Steve Miller, Slim, okay, extremely well known. Steve Miller has more experience than any other individual trader. The guy started trading in his early 20s. He's now in his 60s, semi-retired. So we invited him, come along, come here to TheoTrade. And we've got Steve Miller. In terms of market technicians, you will not find a better group anywhere, hands down. Now, yeah, I make fun of stops and so forth, and yeah, I'm a little bit tongue-in-cheek about technical analysis. If you want to learn charts, okay, I know my weakness in this business, and it's charts. So what did I do? I went out and tried to find the single best market technicians that I could. And that's why we brought on, Tony, Doc, Slim, Bierman. All of them are instructors here, okay? And all of them are there to answer questions for you. So I've covered a little bit about the class that's coming up on Saturday, October 29th. And again, you can't make it live. It is recorded. Everything is available. The PowerPoint presentation is available instantaneously after the class. Now, Total Theo, it's a 12-month mentorship. This is a little bit overwhelming, and that's why I want to describe it. So it's $997, but I want to be clear about something. We don't have anything else, meaning for a year, okay, every class that we're going to do for the coming year and every class that we've done for the previous year, everything, it's included in here. If there's a technical study and we have to write secret code for the technical study, we give it to you. We give you everything, okay? Your education for every one of these classes is included. The sell premium and minimize your risk class, okay? That was like, the golden child of all the classes I've ever done. It's a monster. I mean, I put my blood, sweat, and tears into sell premium and minimize your risk, right? The fractal energy class, Doc, you're going to love it. It's actually got a custom script in it as well. I think you guys will really appreciate that. But in addition to it, here's some of the classes we're going to be doing. Cash secured puts, how to buy stocks for less. Guess what? That happens to be tomorrow. I'm actually going to do a class tomorrow on cash secured puts. So if you're a member of Total Theo, it's tomorrow night. Boom, it's Wednesday night, because every Wednesday night we do a mini class, calendar spreads, futures trading, pairs trading. These are all upcoming topics, butterflies, right? In addition to it, we actually do 5 hours live in a chat room every day. You don't have to be in there every single day, but if you are, great. All of it's archived, and I want to actually show you what those archives look like. So bear with me for a second. When you go into TheoTrade, this is our site, right? So I'll go to the home screen over here, and I say, this is our site. This is what it looks like. If you go into our chat room, click right there on the chat room itself. What does the chat room look like? Well, here's where actually we broadcast. This would be broadcasting like a TV screen. And here's where you can actually chat in. So, you know, there are thousands of members now of TheoTrade. So you can see there's an announcement. Selling puts to acquire long stock. Don Kaufman, 7 p.m. tomorrow night. Right? It's before the debate. Don't worry. Okay? That's actually at 7 p.m. Central Time over there. But if you're at Total Theo, you also have access to everybody's archive. Jeff Bierman, Doc, myself, Slim Miller. Okay? But take a look at the class archive. So Total Theo gives you immediate access to everything. Surviving the extreme volatility, sell premium managed risk, iron condors, high probability, options 101, you name it. Okay? There's a class in here for it. RSI Unleashed, building a comprehensive trading framework. Oh, the next big short. We didn't even put that in there. That's the risk twist. Unleash the power of thinkorswim. If you are a thinkorswim user, I had to do a class just on that because, well, people asked me to. So that's the classes, but that's nothing. Now I'm going to overwhelm you a little bit. Okay? Here's the coaching session archive. What's a coaching session? Each day, we're doing approximately 2 hours of coaching sessions a day now. That means there's continuing education. If you can't tune in every day, I get it. But you could just click on, for instance, September. Parabolic stop and reversal. It's a technical study. Get your hedge on, all right? Fixed ratio money management. Bollinger Bands. If you have a topic, okay, realize how many months are in the archive over here. Is it overwhelming? Yeah, but I want you to recognize this is the one-stop shop. In addition, we even email you out trades. We email you out trades. Look, there's a TheoTrade tracker. Every single trade that we do, I put it in the easiest spreadsheet format that I could. When we open it, when we close it, we email the trades out to you. So if you don't have your own trade ideas and you want to look over somebody's shoulder, you can do that. On top of it over here, if you're into like some shared scans and studies, I know a lot of places out there and they sell all kinds of studies and you got to buy this, you got to buy that. Forget about all that garbage. We just give them to you. Here's all the different studies. And if you're not on thinkorswim, that's okay too, because we actually wrote code down below. We've even got some TradeStation codes on here. It's a party at TheoTrade. Again, we try to make what we call Total Theo include everything. And that's what we charge, $9.97 for it. But listen, one class in here is worth, the $1,000 over there. It's nothing. What I want you guys to know, you don't have to add anything to your education. We don't have anything beyond what we do here at Total Theo. So I'm actually going to answer a few questions for you. And again, at the very least, go to the essential skills for consistency in trading. If I can save you a few $1,000, forget for a second about making money. Pay $197 and learn not to lose it again. We're actually going to get some really detailed, but the 5 classes that come with essential skills for consistency in trading, okay, you're not just going to enjoy them, you're really going to get a huge amount out of all 5 classes. And again, even if you have the experience, I stress this, go to the options 101 again, go to the options 201 again. I'm going to get you looking at options and markets in quite a unique way out there. So I'll throw the address up there again. It's theotrade.com/skill. That's the web address, theotrade.com/skill. It'll take you to this page and just select add to cart over there. Now, a couple of questions. All right, does TheoTrade include live trading room access? Of course it does. Yeah, by the way, 5 hours a day we're broadcasting in there. So when you go, it's part of it. All right. Oh, by the way, somebody said with the $997 option, do we have lifetime access to all the courses included in here? The answer is, of course, yes. So not only do you have all the courses that are in here, okay, we've got courses coming up. And then, so we do a course a month. And if you look at it, a course a month, each month you can buy a course for $197. And every single month we're going to do a class. In fact, this month we're doing 2 classes. Doc Severson's going to do a class as well. But every single month, oh, apologize, Doc already did one this month. November, we're going to have another 2 classes too. But we're constantly doing classes out there. And we'll charge you $197 if you want to come to individual classes. You can pay $997 and just get everything we're ever going to do for the next year and everything we've done for the previous year. That's just the way we do it. I mean, it's easier that way. When it comes to it, I ran education, right, for 7 million clients. I've done thousands of classes in 15 years at a brokerage firm. But now I'm unregulated, can actually talk about definitive trade criteria. You couldn't do that before under the regulations of FINRA. So I'm free. All right, a couple of more questions over there. Do you have a quant class? That sounds like a lot more fun than technical analysis. Okay. I'm pretty much your quant geek. And the answer is you want your quant class. The first step in a quantitative trading, it's the high probability, okay, in-out spreads class. It forces you into a quant strategy. I don't actually say that, but it forces you into a quant strategy, which is ultimately quantifying volatility fluctuation and number of occurrences. The other real quant class is sell premium and minimize, apparently says York risk, but sell premium and manage risk is also a pretty heavy quant class out there. There's no technical analysis in either one of those classes. All right. Again, do we have that class on basic technical analysis? Yes. There are a number of classes, again, on basic technical analysis. Every strategy, all right, that's what's done by Jeff Bierman. So Doc is a little bit more of like your hardcore technician. And by the way, for those of you that are joining us, Doc is a engineer. He's a recovering engineer. He's an engineer turned trader. And I met Doc a number of years back, and I've actually watched Doc's career for a number of years. I love it. I always make fun of engineers because they're the most analytical individuals in the world. So when I made fun of an engineer, I'm like, we got to hire ourselves an engineer. And we did. I think you guys will appreciate that. Somebody said, can I pay with PayPal? Yeah, we take PayPal. That works for me. All right. And again, one of the things I try to do is we want to provide everything to you at one low cost. Like, I don't want you to feel like you have to go here and have to go there and you got to buy this software and that software. If it comes to software, it comes to like anything like that, you let us know. Okay. I'm going to try my best to get whatever it is that you need and encompass it into Total Theo. If it's some kind of like crazy, like technical study over there, we have just a crazed, guy that just writes code for us, and he writes code for us, so that you don't have to go out and buy a bunch of different codes, for the different trading applications. It's important to us. Like, I don't want you to have to pay $1,000 a class. It's crazy, right? You come here, you get everything. That's the way we actually built TheoTrade, and I mean that's what we're trying to really design out there. All right, I'm reading back over there. All right, I like this. Sounds too good. All right, be skeptical. Check out the classes. All right, I have no problem with that. Be skeptical. And when it sounds too good, again, I got 15 years in the brokerage industry, regulated by FINRA. I've literally done thousands of classes. I went on a speaking circuit, for 15 years out there. I mean, you name it, I've been there. And what we're trying to do here at TheoTrade is really, again, it's bring everything that you need for trading to you. And I think you'll be not just impressed with the classes, I think you're going to be blown away with the classes. And I do want to say one more time, the class I'm doing on Saturday, October 29th, it's very different than anything that I've actually done to this point. Even those of you that are already members of TheoTrade, it's very, very different. I'm taking much more like a holistic approach into the marketplace and trying to incorporate a skill set that transcends not only market conditions, but transcends strategies. So the way you're approaching everything, okay, gets twisted under this skill set. And I say twisted because you're going to look at a discipline where you're going to go in there, you're going to have the right trade logic, the right allocation, okay? You're going to have directional bias in there. Sure, it's going to be directional bias, but it's not going to be at the forefront. And we're going to show you how to manage risk and look at risk very differently. So your approach to the market, it's going to change. And that's what I'm trying to do. Having looked at order flow for 15 years is really hammer some of those skills and some of the flaws that we have inside of our trading. So with that, it looks like I've got the vast amount of the questions answered for you. Again, can't stress to you enough, TheoTrade.com/skill. And feel free, if you need to reach us, okay, I'm available, support at TheoTrade.com. We all of us read that central inbox over there. Our phone number is 800-256-8876. I want to thank every one of you for joining us this evening. It's been fun, good stuff. Thanks, everybody. And again, I'm going to actually be in our chat room tomorrow morning. The very first thing, you sign up tonight for Total Theo. You can join me tomorrow morning in the chat room. If you can't join me during the trading day, guess what? At 7 p.m. tomorrow night, I'm actually going to do a class. It's actually going to be about selling puts. It's just a little mini class, only lasts an hour. But everything helps out there. Thanks, everybody. Have a great evening. Bye-bye.